It's definitely a less favorable operating backdrop for U.S. companies, and yet the equity market is unchanged. So I think that seems unreasonably optimistic. But when I look outside of the U.S., I see a major fiscal U-turn in Germany, broader spending capabilities in the European Union for military or defense purposes that could really accelerate growth materially in 2026. I also see a capital optimization story in Japan where returns on capital improving for companies there. And I think EM, emerging markets, excluding China in particular, are likely to benefit from this trade tension as companies try to de-risk their supply chains from China to other emerging markets over the next few years. So when I look outside the U.S., I see a number of positive catalysts. In the U.S., I see a market that has rebounded. It's rightfully rebounded from the August 8th lows, but probably rebounded too much at this point. And then one last thing, you've got a U.S. market that still trades at 22 times forward earnings. The emerging markets are at 12.5. Europe is at 14.5. That valuation differential is very large in historical terms.
You just said EM excluding China. Why exclude China?
You know, there's a big debate, and I could literally argue both sides of this debate. The reason not to exclude China is it's such a big part of the opportunity set, and there are a lot of really good companies in China if you're actively choosing those stocks carefully. But from a thematic perspective, when I look at the emerging markets excluding China, I do think there's going to be material movement of capital by companies out of China into other emerging markets. Let's be honest. Even with a 33% weighted average tariff on imports from China, China is still cheaper than producing in the U.S. But if that 33% tariff stays in place for China and everyone else remains at 10%, then there's a real reason for companies to consider moving operations to Indonesia, Thailand, India, elsewhere. And so I think there's going to be an ongoing shift, and that should lift growth rates in other emerging markets, perhaps at the expense of China. Now, one big thing that would change that narrative is I and many other investors have been waiting for at least a year now for the Chinese central government to deliver strong fiscal stimulus to increase domestic demand. If we get that, that could actually make China more attractive over the next 12 to 18 months.
And Ron, I feel like the market is getting this feeling, this eerie feeling that the ceasefire on the tariff front, at least when it comes to the U.S. and China, that perhaps it's a very fragile one. Do you think at all that maybe the government's focus moves on to the financial decoupling, not just about tariffs and a trade relationship, but perhaps we're looking at potentially the risk of forced delistings of Chinese companies from the U.S. equities markets? Do you think that could come back?
Well, maybe if I could start with your first comment, because I think it's very important about the fragility of this truce. It's interesting, if you look at the communique that came out of Geneva, one paragraph basically said the U.S. would lower tariffs, another said China would lower tariffs, and the third paragraph said we'll negotiate everything else. And even this week, we've seen China complaining that U.S. initiatives to constrain Huawei might violate the spirit, if not the letter, of what was discussed in Geneva. So I think you make a very important point that this is by no means the end of U.S.-China trade friction. And I think your second point or question is important. Again, the U.S.-China friction is not going to go away, in my view, regardless of whether it's a President Trump or the next president after Trump, because there is a bipartisan view in the U.S. that China is no longer just an economic competitor, but a national adversary or a strategic adversary. So I think there is risk that these moves move beyond manufactured goods and tariffs, and that there could be other constraints on financial engagement across countries, perhaps delistings, but also including other forms of direct investment in the private markets and other ways of constraining capital from benefiting certain entities in China that might work on dual use, i.e. military uses of technology, for example. So I think there's a lot more runway on that story, and it's by no means over. And I do worry, by the way, that even the current tariff rate on China is likely to go higher, because keep in mind, right now there's certain product categories that are exempt from those tariffs in China, where we expect sectoral tariffs such as semiconductors, pharmaceuticals, copper, lumber. So there's more to come on the tariff front.